guys, this is MommyBelluga Investing.
Hi there, back again with me Ratih in MommyBelluga Investing. With the heating up defense situation in the Asia Pacific and in the world, we expect some drastic changes in how countries spend their defense budget in the near future. That makes me interested in knowing what kind of company in SGX that can survive or thrive in this kind of new climate. In this video, I turn my attention to STEngineering, a global technology defense and engineering group with a diverse portfolio in business across the aerospace, smart city, defense, and public security segments. So this company has some emphasis on defense as well. However, my quick take for the company after looking at the companies and the numbers, unfortunately, by reading its 2020 annual report, I'm unable to see its potential growth in defense segment. But the company seems to be pretty stable over these years, giving out a healthy sum of dividend, which compared to the company's earnings seems to be pretty sustainable. I can see that the company is betting its potential for aerospace, smart city segment, and AI. So for now, I'm rather interested in putting but a small position in the company. If you're not aware, I extracted data from the company's annual reports over the year and post the analysis regularly in this channel. If you're interested in that sort of thing, please consider to subscribe. Disclaimer, this is an amateur video from my personal research. This video shouldn't be regarded as a recommendation to sell or buy stock in the stock market. Alright, let's look at the company's profile. STEngineering is a global technology defense and engineering group with a diverse portfolio of businesses across the aerospace, smart city, defense, and public security segments. This company was created in December 1997 as a merger of 4 listed companies. They are ST Aerospace, ST Electronics, ST Kinetics, and ST Marine. STEngineering shares debuted on the Singapore Exchange on the 8th of December 1997. Prior to 2020, STEngineering operates in 4 strategic sectors. They were aerospace, electronics, land system, and marine. In 2020, the company restructured into 2 customer-focused clusters. They were, first, the commercial cluster, which consists of commercial aerospace, urban solution, and satellite communication. The second cluster was the defense and public security cluster. In there, they have digital system and cyber, land systems, marine, and defense aerospace. Just last year, in 2021, the company restructured again, and the 3 reportable business segments, as we can see on the screen, became, the first one is on the left, the commercial aerospace, and then the second one on the right, the urban solution and satcom. And the last one, the third one, was defense and public security. In 2020, the commercial aerospace and urban solution and satcom were put in the same cluster. And now, later on, in 2021, they were separated into 2 different reportable business segments. Based on the 2021 annual report, the main revenue comes from defense and public security segment, which made up more than half of the total company's revenue. Then in November 2021, the company presented their next 5-year plan, 2022 to 2026. The graphic on the right here is taken from the company's 2021 annual report. The 5-year plans involve the recovery in commercial aerospace, drive growth in smart city. Though the annual report mentioned expanding international defense business, the defense growth was not in the graphic here we have on the screen. Instead, they have digital business and grow other core business. I guess the defense growth can be glossed over as grow other core businesses. No target for defense business was listed in the annual report, but if you look at the graphic on the right, the target revenue for commercial aerospace and smart city in 2026 were around the current revenue, each were around the current revenue from defense and public security. So more than double for 2021 Urban Solution and Satcom, and increase of around 50% in 5 years for commercial aerospace. I like it that they have a concrete target. The company seems to be quite confident with their target too. But yeah, as this is a target, the result is yet to be seen. Right now, let's move on to the numbers. Let's see how they are faring for the last decade or so. Let's see their earnings per share for the past decades or so. On the screen, we have STEngineering EPS data since 2008. The earning per share here are plotted as red round markers connected with a red line. I also added a green dashed line to indicate the zero earnings, where earnings below this line indicate that companies recorded a loss in that period. The good thing is that the company has never recorded any loss since 2008. I kind of hope that the company's EPS show a growing trend, but we can see here on the screen the EPS seems to be pretty stable since 2008. There was a period of growth between 2009 to 2012, but the overall EPS since 2008 doesn't seem to show that STEngineering is a growing company. There's no actual increase in trend. I'm actually a bit disappointed here, but perhaps the period of growth hasn't started yet, so it's still yet to be seen. The cash position here I plotted as green bars. The number of EPS can be seen on the left. Yeah, compared with the EPS again, yeah, the number of EPS can be seen on the left, while the number for the cash position can be seen on the right in million Singapore dollar. Let's look at the screen. We can see that the lowest cash position was in 2018, and we can see an increase from there on. Yep. And here I plotted the current liabilities as purple bars since, again, 2008. This comparison on the screen helped me to judge the company's liquidity and its ability to operate. Without operation, there will be no profit, right? The picture I would like to see is that the cash position to be higher than the current liabilities. It means that the company has the cash to pay for its current liabilities. However, what we can see here is that the current liabilities consistently way higher than the cash position since 2008. We did a quick check in SGX and found that in 2019 or 2019, STEngineering sold one of its companies, bought some, and then established one joint venture. The company seems to be transforming and venturing from those moves. More recently, in 2021, the company also bought a company, TransCore. Yeah, it's called TransCore, an electronic road pricing company in the US. Based on the company's 2021 annual report, the acquisition of around 2.68 billion was said to be the biggest acquisition in the company's history. The impact of this acquisition to the company's finance is probably yet to be seen, since it's still very recent. It was completed only in March 2022. For those who have watched my financial journey video are probably aware that I'm keen on adding dividend-paying company into my family's portfolio. My ideal target is in the range of around 6% per year, but I'm rather okay as long as it is 3% and above. So on the screen, I have plotted the average dividend yield per year as the round markers. And at each of the markers, I place an arrow bar, which represents the range of yield over that year. The variation in the year is caused by the volatility level of the share price. The yield increases if the share price decreases and vice versa. As we can see from the screen, the companies had some years of generous dividends, but their latest dividend yield is around 3.5%, which is quite okay for me. In comparison, the latest SSB, which was in August SSB, was around 3% in 10 years. So this dividend yield, I can see that it's pretty decent, yeah, if the company, especially if the company has a potential of growth in the future. Then my next question is whether the company can actually afford giving such dividend. Now let's compare the company's dividend payout and EPS. To see the dividend payout and its sensibility, so here I plotted 3 layers of information. The first one is the dividend payout since 2008, which are plotted as red round markers connected by a thick red line, as we can see on the screen here. On each of the points, I have annotated with 2 numbers. The numbers above the markers are the dividend payout in Singapore dollars, and the ones below are the payout ratios to the respective year's earning per share. As a comparison to the earnings, here I plotted back the EPS or earning per share as a thinner line with the same color, red. There were actually 2 occasions when the company distributed more than its EPS. Those are in 2010 and 2019. Other than those 2 years, the company appears to be still rather generous, but not precariously dangerous or generous as those 2 years. I'm rather interested in this company so far, so my next question is whether the current price is reasonable for me. To see STEngineering's reasonable price, here I plotted 4 layers of information. The first one is the price, which represents market valuation of the company. The second layer of information is the 10 times earning multiply, which here I plotted as a dashed green line. 10 times earning multiply can be considered as the price, where price to earning, that is the PE ratio, is 10. For me, I consider 10 times earning multiply has 2 purposes. First, it indicates the price where I have higher chance to break even within 10 years. You could also plot 5 times earning multiply if your investment horizon is 5 years, for example. Second, as a consequence for the first reason, I'll consider share price above this 10 times earning multiply to be expensive. The third layer of information is 15 times earning multiply. With the same principles as a 10 times earning multiply, price above this indicator will be deemed as expensive. So here I plotted the 15 times earning multiply as dashed yellow line, just like the traffic light. Green, yellow, and then red. The fourth layer of information, as expected, is a 20 times earning multiply. Here I plotted as a dashed red line. I consider the share price to be super expensive if it ever crossed this line. For the growth company, I consider to cut down my position if this ever happened. So now let's look at the screen. Let's see what's going on with STEngineering share price. In general, we can see an uptrend in STEngineering share price over the years since 2008. However, as we can see on the screen as well with the earnings multiply here, the trend doesn't seem to be supported by its fundamental. The earning multiply or the EPS seems to be quite stable, but the price is showing an uptrend. Before 2011, the share price hovered around 10 to 15 times earning multiply. After stable around 15 earning multiply between 2013 to 2017, in 2017, the stock price climbed and then hovered around 20 earning multiply. There was a deep in 2020, which in all likelihood induced by pandemic, but afterwards STEngineering share price continues with its uptrend. The increase in share price I've mentioned earlier doesn't seem to be supported by its fundamental, and it actually concerns me. As of 8th of August 2022, when this video was prepared, STEngineering stock price was at 4.08 Singapore dollar, which is around 22-ish times earning multiply. It will be better if I can get the share at 3.7 Singapore dollar per share, which is the price at 20 times earning multiply, but considering the trend, I don't think that's possible in the near future. I don't think it's possible to get the price at 3.7 in the near future. All right, now for conclusion. Yeah, I'm not that happy with the company's share price uptrend, especially when it's not supported by its fundamental, in this case, growth in earning. However, the company seems to be pretty stable in terms of its earnings, and then giving out healthy sum of dividend, which compared to the company's earnings seems to be pretty sustainable. So I'm interested in putting a small position in its current price, hoping for a growth and stable dividend payout in the horizon. Right, that's what I can say about STEngineering. I revisit STEngineering after my previous analysis last year with the hope that the company is going to do well and in defense sector. Yeah, considering the current defense climate in Asia Pacific and in the world in general. However, after looking at the company's latest annual report, I found that the companies intend to grow their aerospace and smart city segment instead. There's no actual concrete target on how they're going to increase their earnings or revenue in the defense sector though. Nonetheless, though the growth is yet to be seen as well for all of the target, I'm rather interested in putting a small position, hoping for a future growth and stable dividend payout, as I mentioned earlier. Alright, if you find this content to be informative or interesting, please consider to support by clicking the subscribe and perhaps like button as well. Appreciate your input to improve this channel through the comment section. You can also access this channel through podcast version through AnchorFM, Spotify, Google Podcasts, Apple Podcasts, and other podcast platforms. I'll see you again in my next video. Goodbye.